Hello friends, today is my 30th presentation for the team of Finance and Accounts, and the topic is 76 causes that can adversely impact the financial reporting of equity and dividends in the balance sheet. Overall, this is my 61st presentation considering all the YouTube presentations that I have made so far. What I plan to include in this presentation are, and first of all, an overview of the different types of shares with their purpose and key features, and 76 ethical issues identified. Then in the following slides, I'll be sharing ethical and strategy aspects in reporting the various for vis-a-vis various shares like equity share with voting rights, with the differential voting rights, compulsory convertible preference shares, optionally convertible preference shares, redeemable preference shares, shares reserved for issuance, bonus shares, shares reserved for issuance, ESOPs, buyback of shares, dividends to be declared and paid, public issue of shares, and reserved and surplus in the balance sheet. Overview is like this. Yeah, in the second column, you find the description of the type of the equity shares, and third column is number of ethical issues that have been identified in this presentation. So equity shares with the voting rights, there are 7 issues. Equity shares, in fact, these issues include ethical and strategy issues. Equity shares with the different voting rights, 6. Compulsory convertible preference shares, 8. Optionally convertible preference shares, 9. Redeemable shares, 8. And so on, so and so forth, adding up to 76, which will be captured in the following pages. Number 1, equity shares with voting rights. Purpose and features. Purpose is to raise capital for the company, offer ownership rights and control to the shareholders, enable shareholders to participate in the decision making via voting on the resolutions, and entitle the shareholders to share profits through dividends proportional to the voting rights in some cases. Key features: ownership is the shareholder owns part of the company. Voting rights, yes, 1 vote per share typically. Dividends, no guarantee, depends on the profits. Growth potential high, share prices can fluctuate considerably. Liquidity higher due to greater demand. Now, ethical issues. These are divided into categories. One is funds utilization related, second is the reporting requirement related. Number 1 is funds related. Using the funds for personal gain or unrelated business ventures, diverting the funds for illegal activities like bribery or corruption, withholding the funds from the legitimate company purposes. Reporting requirements related. Inaccurate disclosure of the share features such as face value, issue price, or redemption terms can mislead investors about the true value and rights associated with the shares. Number 5 is omission of the material information like type of class, voting rights. 6 is improper accounting of the voting rights, leading to differential for misleading financial statements. Number 7 is inadequacy in the actual disclosure vis-a-vis requirements for classification like equity, preference, redeemable, or bonus share, etc. vis-a-vis Companies Act 1956. For this, you can refer to the guidance note numbers which I have given starting from 8.1.1.5 to 8.1.16, including the Schedule 6 and issued by the ICAI, Institute of Company Accounts of India, Chartered Accountant of India. Next is equity issues, equity shares with different voting rights, simply called DVR. Purpose and features. Purpose: diverse investors. DVR allows companies to issue shares with varying voting rights, appealing to the investors who prioritize high returns over voting control. Number 2, maintain control for functions for founders. Founders can issue DVRs to raise capital while retaining greater voting power to ensure control over the strategic decisions. Number 3, differential voting structure. Companies can create multiple DVR classes with different voting rights, with classes with tailored voting rights suitable for specific investment type. Key features: the DVR holders, they own part of the company. Voting rights, yes, they can, but proportionate to the percentage specified. Dividends often higher dividends offer higher dividends compared to the dividends to compensate for the reduced voting rights, but no guarantee and depends on the profits. Growth potential varies depending on the conversion terms. Liquidity, lower liquidity compared to the standard equity shares due to less demand. Ethical issues. Funds related personal gains, unrelated ventures, illegal activities for bribery, misrepresentation for the use of use, disclosing how the company tends to use the DVR issuance, control manipulation, issuing DVRs to manipulate, control, and disenfranchise the other shareholders with lower voting rights. Reporting requirements related: misleading financial statements, inadequacy in the actual disclosures. I have stated the schedule at 6 and the various guidance notes. Compulsory convertible preference shares (CCCPS). Purpose and feature. Purpose: compulsory preference shares must be converted into equity shares after a specified period or upon a triggering of the event. CCPS is preferred by the investors looking for stable initial fixed dividend returns with an opportunity for growth upon conversion into equity shares. 3. Further, CCPS provide preference in dividends and liquidations compared to the common equity, offering some protection for investors. Fourth, it bridges gap where investors and promoters have different valuation expectations for the company. Key features: the holders own part of the company. Conversion is later. No voting rights after conversion. Paid bribery. Paid before equity shareholders. Paid after conversion. No guarantee, depends on the profits, dividends. Growth potential for high growth after conversion. Risk level, lower risk level compared to the equity shares due to fixed dividends and priority in liquidation. Ethical issues: funds related, using CCPS funds for personal gain like earlier stated, diverting CCPS funds for illegal activities like earlier stated, withholding CCPS funds from illegitimate company purposes, using the CCPS funds to pay excessive compensation to promoters or management, disregarding the rights and interests of the CCPS holders during conversion or other company actions and manipulating this. Reporting requirements: failing to disclose the true purpose of the raising capital through CCPS, delaying or manipulating the conversion triggers to benefit certain stakeholders, inadequacy in actual disclosures vis-a-vis the Companies Act, and as per the Schedule 6, various clauses are mentioned here. Optionally convertible preference shares. Now, purpose: flexibility for investors, offers investors the option to convert their shares into common stock at a later date if the company performs well. Full control: shareholders decide whether to convert or not. Offers attractive dividends, typically offer fixed or variable dividends payments to entice the investors seeking steady income. Phased conversion option allows the company to control the timing of the conversion based on the predefined conditions. Key features: the OCPC shareholders own part of the company on conversion with the conversion option. No voting rights, typically example may have limited voting for in some cases. Convertible if the product is successful. No dividends, no guarantee, depends on the company decision and the profits. Growth potential for high growth if converted. Risk level, lower risk level compared to the equity shares due to fixed dividends and priority in liquidation. Ethical issues: funds utilization related, using OCPS. These are the basically same 4 points which were there for earlier compulsory convertible shares, preference shares. Last one is disregarding the rights and interests of the SCPS shareholders hold during conversion or other company actions and manipulating these. Reporting requirements: failure to disclose the true purpose of the raising capital through OCPS, delaying or manipulating the conversion triggers, ignoring shareholders' communication, failing to keep OCPS holders informed about relevant company developments or conversion opportunities. Inadequacies in actual disclosures. These are mentioned in the reference guide notes which are there vis-a-vis Schedule 6 of the Companies Act. Purpose and features: redeemable preference shares. Company can redeem shares after a purpose is company can redeem shares after a specific period on a specific date. Fixed income for investors, offers investors a fixed dividend stream similar to the bond but with a potential for capital appreciation. Exit strategy for investors, provides investor with a clear exit option at a predetermined price or at a set date. Uh, financing Financing flexibility, provides companies with a way to raise capital without issuing permanent equity, offering flexibility to replace the shares later. capital structure management allows companies to manage their capital structure by repurchasing shares when advantageous, potentially reducing the overall financing cost. Key features for the redeemable preference shares. Ownership is it is a loan like ownership, but priority over common shares. Voting rights, no voting rights typically. Example, company expanding facilities with option to buy back shares later. Dividends, fixed dividend, priority over common shares. Growth potential, a limited growth potential but offers steady income. Risk level is lower risk compared to the equity shares due to fixed dividend and priority in liquidation. Ethical issues, funds related, redeeming shares early to avoid future dividend payments, harming investors' interest, diverting redeemed funds for illegal activities, redeeming shares to manipulate the company's stock prices for personal benefits, using redeemed funds to pay excessive compensation and to promoters of management, senior management, not providing fair treatment to preference shareholders during the redemption process. Reporting requirements related to the rated, including Accounting Standards Rule 2006. Failure to disclose the true purpose behind the redeeming shares is one issue. Second, the redemption cost inaccuracy and inadequacy in actual disclosure vis-a-vis the requirements stated in the Schedule 6 issued by the ICAI. Share reserved for issuance, bonus shares, purpose and features. Purpose: additional shares are given to existing shareholders without any extra cost based on the number of shares they already hold, rewarding existing shareholders for their loyalty and investment in the company. The company's total capital increases, but there is no inflow of the fresh funds. Key features: similar to that equity shares. Voting right, yes, same as original equity shares. Dividends entitled to only same dividend as original equity shares. Potential same as original equity shares. Risk level same as original equity shares. Ethical issues: 1. Issuing access bonus shares can initiate the holding and voting rights of promoters, giving them more control over the company. Inaccurate share valuation, incorrectly valuing shares, particularly bonus shares or shares issued at a premium. 3. Inadequacy in actual disclosures vis-a-vis the requirements of Companies Act. Now, this is specific guidance note number 8.1.1.9, which you can refer to vis-a-vis Schedule 6 of issued by the ICA, Institute of Chartered Accountants of India. ESOP, shares reserved for issuance. ESOP, purpose and features. Purpose: shares offered to employees as part of the compensation package, usually at a discounted price or as an option. And number 2, purpose is to retain, motivate employees by giving them a stake in the company. Number 3 is granted based on the company's ESOP policy, exercisable after the investing period. Key features: uh, ownership, employees typically vest over time, uh, meaning they gradually gain ownership of the shares. Voting rights, yes, upon exercise and conversion into equity shares. Dividends, they are entitled to dividends of liquidity depends on the vesting and lock-in periods. Risk level dependent on the company's performance and market prices at the time of exercise. Ethical issues: companies might design ESOP schemes that unfairly benefit management or specific senior management groups. Inadequacy in actual disclosure vis-a-vis the requirements. These are specified in 2 guidance note 8.1.1.2 and 8.1.1.115. Bias granting of ESOPs, which is not based on the merit of the actual performance of the same employees. Buyback of shares called treasury stocks. Purpose: equity shares utilize there are 2 types: equity shares buyback and preferential buyback. Number 1, equity shares utilize excessive cash. Companies with surplus cash might buy back shares to utilize the excess cash in a way that benefits shareholders, enhance shareholder value by reducing the number of outstanding shares. The earning EPS typically increases, which can enhance shareholder value. Defend against takeovers, reducing the number of shareholders shares available in the market can make it more difficult for any outside party to acquire controlling interest. And tax efficiency. Preference shares fulfill obligation. Companies might have a contractual obligation to redeem preference shares after a certain period, reduce the cost of capital. Redeeming preference shares can help a company lower its cost of capital, particularly when the preference shares have a high dividend rate. Ethical issues, market manipulation. Companies might time the buybacks to inflate their stocks prices before a period of bad news. Management self-dealing. Managers might use buybacks to benefit themselves by repurchasing their own shares at a premium. Inaccurate reporting failures to disclose shares repurchased by the company. Inadequacy in actual disclosures about the buyback. Regulatory limits on the amount and frequency of the shares buybacks, potentially misleading investors vis-a-vis the requirement of the Companies Act. Dividends to be declared and paid. Key considerations. These are basically company profitability, dividend policy of the company, considering the payout ratio, cash flows, capital expenditure plans, market conditions and investor expectations, dividend payout ratios, uh, debt to equity ratios, current ratios. Ethical issues related to dividends. Shares held by the holding. There are four types of uh, examples. Shares held. Shares held by the holding company. Self-dealing. This could involve declaring excessive dividends that drain resources from the subsidiaries or using its control to issue shares to self, diluting the ownership of the others. Hidden profits. Manipulating the financial statements and transfer of profits between the entities. This could involve underpaying dividends to subsidiaries. Shares held by subsidiaries of the holding companies. Financial strain. The holding company might pressurize subsidiaries to pay excessive dividends, even if it hinders the subsidiary's ability to reinvest in the growth or meet debt obligations. Transfer pricing. The holding company can manipulate the transaction between itself and its subsidiaries to shift the profits. This could involve artificially inflating the prices of the goods or services sold by the holding company to its subsidiaries companies, reducing their profitability. Share held by the associate of the holding company. Lack of control. Associates have less control over the decisions of the holding company compared to the subsidiaries. This can leave them vulnerable to the decisions that might not be in their best interest. Information asymmetry. The lack of transparency about the financial and the associate companies can make it difficult to assess the true financial health of the holding company. Shares by the associate of the subsidiary company. Indirect impact. If the holding company prioritizes short-term profits over long-term investments in the subsidiary, it could ultimately harm the associate business prospects. Limited influence. The associate of the subsidiaries might have limited ability to voice their concerns on all the challenge decisions made by higher ups in the corporate structure. Now, common points vis-a-vis the dividends. Delayed credit of the dividends to the shareholders as per the due dates is unethical. Inadequacy or inactual disclosure about the dividend payout to the each category of the shareholders explained above. And for this, there are two different reference guidance notes, 8.1.1.0 and 8.1.111. IPO or public issues of the shares. Key considerations. These are primarily company valuations using method of discounted cash flow, comparable company analysis, and precedent transaction to determine the fair value range of the shares. Market sentiments and timings related parameters. A strong market may support a higher price, while a weaker market might necessitate a more conservative pricing approach. Competitive landscape. Analyzing the pricing of the recent IPOs in the same industry or sector to ensure that offer price is competitive and attractive. Financial performance and growth prospects. Underwriters' recommendation about the size and the price. Ethical issues. Misleading prospectus, manipulating information on financial health, profitability, future plans, future growth, and potential risk. Insider trading, price manipulation, allocation irregularities, underwriting conflicts. This includes if the underwriter managing the share offers having a financial stake in the company, it can create a conflict of interest and potentially bias their recommendations. Hidden fees and charges, neglecting due diligence, which is very important point, selecting selective disclosure of the information, and governance aspects, failing to consider the disclose the company aspect on the environment, its social responsibility and practices, and corporate governance can be unethical, especially for the investors who prioritize these factors. Reserves and surplus. And five types of reserves are captured here. One is the retained earnings, second is share premium, third is the revaluation reserve, fourth is the capital redemption reserve, and fifth is the general reserve. Now, purpose of each one of these is for the retained earnings, purpose is reinvest debt reduction, dividend payouts, and contingency fund. And benefits are allows for the reinvestment, enhances financial stability, and provides a buffer for tough times. Sources of funding is accumulated profits after dividend distribution. Share premium reserve. Purposes for writing off preliminary expenses, issuing bonus shares, and meeting legal requirements. And source of funding is premium received on issuing shares above their face value. Revaluation reserve. Purpose is reflecting the increased value of the assets, strengthening the balance sheet, and source of funding is incremental value from revaluing the company assets. Capital redemption reserve purpose is ensuring funds are available to redeem preference shares or equity buyback, and source of funding is transferred from the retained earnings when shares are bought back or preference shares are redeemed. General reserves purpose is meeting the unforeseen circumstances, expansion, and contingencies, and source of funding is transferred from the retained earnings. Ethical issues. Inaccurate calculations of the amounts, inconsistent accounting policies, that is changes in the accounting methods for recognizing or valuing the reserves, lack of transparency, manipulation of the profits, hiding potential liabilities, improper use of the reserves, classification errors to distort the true picture, management discretion abuse, lack of internal controls, inadequacy in the accurate disclosure for each category of the shareholders versus the requirements of the Companies Act. And here there are specific number of specific notes starting with 8.1.2.2 to 8.1.2.10 included in the schedule 6 of the guidance note. Future references. Building on the profitability and ethics, my second book released in November 23. This blog focuses on ethics and statutory aspects of the equity and dividends. More details can be seen in chapter 7 of my second book mentioned above. Please do stay tuned for the insights. My forthcoming third book will dive deeper into the smart balance sheet strategies and ethical practices that can unlock the profitability. You can also refer to some of the articles of interest on my website, on the Facebook and LinkedIn articles. Thank you.